All right, welcome to the Explainer. Listen, if you're connected to the military in Maryland, you already know that tax season can feel, well, like you're trying to navigate a maze in the dark. So today, we're going to hand you the map. We're doing a deep dive into the specific Maryland rules that affect your income, all the way from active duty pay to your retirement benefits, so you can make sure you're getting every single benefit you've earned.
Okay, here's our game plan. First, we're going to bust a common myth that'll save you a ton of headaches. Then we'll lay the groundwork with the single most important concept in all of military taxes, domicile. After that, we're talking numbers, including some really powerful strategies to lower your tax bill. And finally, we'll wrap up with some special cases and show you exactly which forms to use to make it all happen.
All right, first things first, let's tackle something that sends people on a wild goose chase every single year. Getting this straight right off the bat is, well, it's absolutely crucial.
So this is the question, right? It's one that trips up even seasoned pros. You hear about it, maybe your clients ask for it, but what is it, really?
And the answer is, well, it's pretty simple. It doesn't exist. Seriously, there is no such thing as a standalone Form 502M in Maryland. If you go digging through the state's tax forms, you're not going to find it. It's a complete myth. Okay, so if it doesn't exist, why does everyone talk about it? Well, that's where the confusion comes from. The letter M pops up in two totally different places, and you can see them side by side here. On the one hand, you've got the M checkbox on your main tax return, the Form 502. That's just a little flag you raise for the state to say, hey, there's military income here. On the other hand, you have Form MW507M. That's a totally different thing. It's a withholding form a military spouse gives to their employer. See the difference? One's a checkbox on your return, the other is a form for an employer. Mixing them up is where people get into trouble.
All right, now let's shift gears and talk about the absolute foundation of every military tax situation in Maryland. I'm talking about domicile. If you don't get this right, nothing else matters.
So let's be crystal clear on what domicile actually means, legally speaking. You can have a bunch of residences, right? Places you live, but you can only have one domicile at a time. The way to think about it is this. It's your true, fixed, permanent home. It's the one place you always intend to return to, no matter where you're stationed. And this is where a huge federal protection comes into play. You see, Maryland has this rule, the 183-day rule, that says if you're physically in the state for more than half the year, you're considered a resident for tax purposes. But, and this is a big but, for active duty military, the Federal Service Members Civil Relief Act, or SCRA, completely overrides that. So a service member whose domicile is, say, Texas, can be stationed at Fort Meade 365 days a year, and they will never become a Maryland resident for tax purposes, as long as they maintain that Texas domicile. And this table just lays it all out perfectly. There are really only two paths you can go down, and it all boils down to your domicile. Is Maryland your domicile? Okay, then you file a Form 502 as a resident, and your military pay is taxed. Is your domicile another state? Then you file a Form 505 as a non-resident, and your military pay is exempt. It's really that black and white.
Okay, now for the part I know a lot of you have been waiting for. Let's get into the single most important subtraction available to military retirees in Maryland. We're talking specifically about what's in the Tax General Article, Section 10207Q.
Now, who's eligible? You know, the definition of military service here is actually a lot broader than most people think. It's not just the armed forces. It also includes commissioned officers of the Public Health Service and NOAA. And here's a really critical detail. The law also covers death benefits. That means if a surviving spouse is receiving Survivor Benefit Plan payments, or SBP, that income is also eligible for this subtraction.
So let's talk numbers for the 2024 tax year. That's the return you'll be filing in early 2025. If a retiree is under the age of 55, they get to subtract the first $12,500 of their eligible military retirement income. That comes right off their Maryland adjusted gross income.
But then, things get even better. Thanks to a piece of legislation called the Keep Our Heroes Home Act, once a retiree hits age 55, that amount gets a serious boost. For anyone 55 and older, the subtraction jumps all the way up to $20,000 for the 2024 tax year. That's a pretty clear signal from the state that they want to keep skilled veterans right here in Maryland.
Okay, so we've got the basics down. Now let's get into a more advanced strategy, something that can really dramatically lower a retiree's tax bill. It's a technique we call stacking, and it involves using two different state laws to your advantage.
So, here are the two tools in our toolbox. On the left, you see the military subtraction we've been talking about from Section 10207Q. And on the right, you've got the General Pension Exclusion from Section 10209. Now pay close attention to the key difference here. The General Pension Exclusion gets reduced dollar for dollar by any Social Security benefits you receive. The Military Subtraction? It does not. And that little detail is the secret ingredient for our stacking strategy.
This case study of Colonel Smith really shows you how this works in practice and why the order you do things in is so important. Now, the law says you can't double dip, but you can stack. So for the Colonel, who's 66 with a $60,000 pension, what do we do first? We apply that powerful military subtraction of $20,000. We use that one first because it's not affected by Social Security. Now he's got $40,000 of his pension left. Then we apply the General Pension Exclusion, which is capped around $39,500. So what's the result? He gets to subtract a grand total of $59,500, and he only pays Maryland tax on the last $500 of his pension. That is a massive tax advantage.
All right, let's pivot and look at two very different situations. First, we're going to look at a subtraction that, well, it looks good on paper, but almost never works out. And then we'll talk about an exemption that is an absolute game changer for military families. So Maryland has this law, Section 10-207P, that offers a subtraction of up to $15,000 for military pay earned overseas. Sounds great, right? Well, here's the catch, and it's a big one. There's a hard cap. The entire subtraction gets wiped out. It goes to zero if your total military pay for the year is more than $30,000. Now, just to put that in perspective, a young E4 with just 4 years in is already making more than that in basic pay alone. So for pretty much all full-time, active-duty folks, this benefit is, unfortunately, completely useless.
Now this shows one of the biggest changes we've seen in military tax law in a long, long time. The old way was, if a military spouse lived and worked in Maryland, guess what? Maryland taxed their income. Simple as that. But now, because of recent changes to the SCRA, that spouse can choose to adopt the service member's state of domicile for their own taxes. Think about what that means. If the service member's domicile is a state with no income tax, like Texas or Florida, the spouse's wages earned right here in Maryland can become totally exempt from Maryland's state income tax. That's huge.
Okay, so we've gone through all these rules. We understand the concepts. Now for the practical part. How do we actually put this knowledge into practice? It all comes down to filing the right forms and ticking the right boxes. Think of this as your practical checklist. That big military retirement subtraction we talked about, you claim it on Form 502-SU, using code U. That overseas pay subtraction that's almost never used, same form, code P. The spousal exemption, that requires the spouse to file a Form MW507M directly with their employer to stop the withholding. And of course, don't forget that little M checkbox on the main Form 502. It seems small, but it's what keeps the controller's automated system from sending you a nastygram.
And this table here really brings it all home for the 2024 tax year. It's a quick reference guide. You've got the key statutes, the exact subtraction amounts, the limits, and the critical notes for each and every benefit we've discussed. Honestly, this is the cheat sheet you need to make sure you're getting every last dollar of tax savings you're entitled to under Maryland law.
You know, this quote really says it all, doesn't it? Maryland has constructed a tax regime that rewards the informed veteran. The system is definitely complex, no doubt about it. But that very complexity is what creates these incredible opportunities for anyone who takes the time to actually understand the rules.
So that leads us to the final question. By really understanding these specific codes, we're talking Section 10-207Q, Section 10-209, and the federal SCRA, just how much can a military household really cut its Maryland tax burden? Well, as we've seen, the answer can be a staggering amount. For that retiree who knows how to stack their benefits, it is entirely possible to get the state tax on their pension down to almost nothing. And at the end of the day, that fulfills the whole purpose of the Keep Our Heroes Home Act, rewarding the veteran who's done their homework.